In 1987, one man was paid $550 million, not the value of his shareholding, not a company's profit. His personal compensation for 1 year of work at a firm where he was neither the chief executive nor a member of the board. It was more than his own employer reported in earnings that year. Adjusted forward, it is well over $1 billion in today's money, and it was paid to a man running a trading desk out of an office in Beverly Hills, 3,000 miles from Wall Street, who started work at 4:30 in the morning. 3 years later, he was in a federal courtroom pleading guilty to 6 felonies, facing a 10-year sentence, and the firm that paid him had ceased to exist. Michael Milken is usually filed under greed, the symbol of the 1980s, the man who financed the corporate raiders, the villain of a decade of hostile takeovers. And there is a version of this story that stops there, because it is satisfying and because a good deal of it is true. But that version misses what he actually did, and what he actually did is more interesting and more uncomfortable than the caricature. Because underneath the excess, there was a genuine financial insight. It was correct. It had been sitting in a published academic study for 20 years, and essentially nobody in American finance had acted on it. Milken read it, believed it, and built an entire market on top of it. In the next 45 minutes, I want to take that apart properly. You will see the study, a 1958 book of bond statistics almost nobody outside universities had opened. You will see why it mattered, which requires understanding what a credit rating actually is and what it is not. You will see the market he built from it, and the companies that exist today because of it, several of which you use. Then you will see the turn, which is the part that matters most, how a mechanism for financing companies that could not otherwise borrow became the mechanism for buying companies against their will. You will see the one-page letter that made a small raider as dangerous as a large corporation. And you will see the collapse, the prosecution, and the 6 counts he actually pleaded to, which are not the crimes most people assume, and that gap is worth sitting with. Start with the rating, because everything here depends on it. When a company borrows by issuing a bond, agencies assess how likely it is to pay the money back and assign a grade. The scale runs from the top, AAA, reserved for the most secure borrowers on Earth, down through a long ladder of descending confidence. And somewhere in the middle of that ladder there is a line. Above it, a bond is investment grade. Below it, the bond is speculative, or, in the language of the trading floor, junk. That line is not a law of nature. It is a convention, but it acquired enormous power because it got written into rules. Pension funds, insurance companies, banks and trustees operated under regulations and mandates that permitted them to hold investment-grade paper and prohibited or discouraged anything below it. The prohibition was not a judgment made by each institution about each bond. It was a category rule applied to everything under the line at once. Now consider what that meant in practice for a company. In the 1970s, the number of American corporations carrying an investment-grade rating was startlingly small, a few hundred, out of many thousands of substantial businesses. Everyone else, including profitable companies with real assets and real customers, sat below the line. And below the line, the public bond market was effectively closed, not expensive, closed. If you were not investment grade, you did not issue bonds, because the institutions that bought bonds were not permitted to buy yours. So those companies borrowed from banks, on the bank's terms, in amounts the bank chose, with covenants the bank wrote, and if the bank changed its mind about your industry, you were finished. The alternative was selling equity, which meant giving away ownership permanently to raise money temporarily. That was the structure of American corporate credit, A small elite could borrow cheaply from the entire investing public. Everyone else was a supplicant at a bank. And here is the thing about that line. Nobody had ever seriously tested whether it was drawn in the right place. Which brings us to a book almost nobody read. In 1958, an economist named W. Braddock Hickman published a study for the National Bureau of Economic Research titled Corporate Bond Quality and Investor Experience. It was a work of statistics, not advocacy. Hickman had assembled data on American corporate bonds across several decades, covering the boom of the 1920s, the Depression, and the recovery, the most brutal testing period imaginable for corporate credit. His question was simple. If you had bought low-rated bonds and held them, how would you actually have done, not in theory, but in realized returns after every default, every bankruptcy, and every loss was accounted for? The answer was not what the market structure implied. Low-grade bonds did default more often, substantially more often. But they also paid substantially more interest. And when Hickman worked through the arithmetic, the extra interest on a diversified portfolio of low-grade bonds more than compensated for the losses. Over his study period, a spread of low-rated bonds delivered returns that compared well against high-grade portfolios, and in stretches beat them outright. The finding is less shocking than it first sounds, and that is exactly why it is powerful. The market was pricing low-grade bonds as if they were nearly untouchable, because the institutions that set prices were legally or professionally barred from touching them. When the largest buyers are excluded from an asset by rule rather than by judgment, the remaining buyers get to set the price, and that price will tend to be too low. Hickman had not discovered that junk bonds were safe. He had measured that they were mispriced. Those are entirely different claims, and the difference is the whole story. The study sat there for 2 decades. It was cited in academic work. It did not change how anybody invested, for the straightforward reason that the people who could have acted on it were the people forbidden to. Then a graduate student read it. Michael Milken encountered Hickman's work as a student, first at Berkeley, then at Wharton, and he took from it something more specific than an investment idea. He took a conviction that the rating system was measuring the wrong thing. A rating is a probability of default. It is not a statement about return, because return depends on the price you pay. A bond with a 1 in 10 chance of default is a terrible investment at one price and an excellent one at another, and the rating alone cannot tell you which. The market had collapsed those 2 questions into one, and the collapse created the opportunity. Milken joined Drexel Firestone in 1970, a firm that would become Drexel Burnham Lambert, and which at the time was nobody's idea of a powerhouse. He began trading low-grade bonds, and initially the bonds he traded were what the market called fallen angels. A fallen angel is a bond that was investment grade when issued and has since been downgraded. The company ran into trouble, the rating dropped below the line, and the institutions holding it were suddenly obliged to sell. Not because they had re-examined the company, because a rule required it. That is a forced seller, and forced selling is the most reliable source of mispricing in finance. The seller is not weighing value against price, they are complying. Milken bought from them. To do that with any confidence, you have to actually know the company, its assets, its cash flows, whether it can survive. And this is the part of the story that is usually skipped. Milken worked obsessively. He read the filings nobody read. He built a knowledge of hundreds of marginal companies that essentially no one else on Wall Street possessed, because no one else had a reason to acquire it. The bonds were untouchable, so why study them? It is worth pausing on how that operation physically worked, because it explains a great deal about what followed. In 1978, Milken moved his department from New York to Beverly Hills. The stated reason was family, but the effect was operational. Working on Pacific time meant that when the New York market opened at 6:30 in the morning his time, he had already been at his desk for 2 hours. He began at 4:30. Colleagues describe a man who was on the telephone essentially continuously for the entire trading day. The desk itself became famous, an X-shaped configuration with Milken at the center, so that he sat within earshot of every trader and every conversation. There was no private office and no door. Information about who wanted what flowed to one point, and that point was him. And this is the thing that made the network work. He was not merely a trader with good judgment about bonds. He was the person who knew at any moment which institution had cash to deploy, which was under pressure to sell, which fund manager would take a particular kind of risk, and what each of them owned. That knowledge was not written down anywhere. It lived in one man's head, and it could not be replicated by a competitor without spending a decade building it. Which is also why it was so dangerous. A market whose liquidity depends on one person's recall and relationships is a market with a single point of failure. For as long as he was at the center of it, everything cleared. The question nobody asked until 1990 was what the market would look like on a day when he was not there. By the mid-1970s, he was running a highly profitable operation inside Drexel, and he had something more valuable than the profits, a network of buyers. He had found the institutions and individuals who were willing to hold this paper, and he knew what each of them wanted. When he needed to place bonds, he knew exactly whom to call. And then he made the leap that created everything that followed. If a downgraded bond could be bought and sold at a sensible price, why did a bond have to start life investment grade at all? Why not simply issue new bonds, original issue, from companies that had never been rated highly and never would be, and sell them at a yield that honestly reflected the risk? Put that way, it sounds obvious. It was not. It required a buyer base willing to purchase speculative paper at issue, and that buyer base did not exist until somebody assembled it. Milken had spent years assembling it. From the late 1970s, Drexel began underwriting original issue high-yield bonds, and the effect on American corporate finance was genuinely transformative. Consider what it meant for a company. Before, if you were not one of a few hundred blue chips, your growth was rationed by what a bank would lend you. After, you could raise money directly from the public markets, in size, on terms you negotiated, provided you were willing to pay a rate that reflected what you were. The companies that used this are not obscure. MCI Communications was attempting to compete with AT&T, a regulated monopoly of vast size, and needed enormous capital to build a network. No bank was going to fund that. Through Drexel, MCI raised well over $1 billion in high-yield debt, and the competition it created helped break the monopoly. Ted Turner used high-yield financing in building his television business, including the launch and survival of a 24-hour news channel that everybody in the industry considered a certain failure. Craig McCaw built a cellular telephone business on it at a time when mobile phones were a curiosity, and eventually sold it to AT&T for many billions. Cable television, an industry requiring vast upfront construction against distant revenues, was substantially financed this way. That is the case for the defense, and it is not a small one. A financial innovation that lets a well-run company with no pedigree raise $1 billion to attack a monopoly is not a trick. It is capital allocation working better than it had before. For roughly a decade, that was the business, and if the story ended there, Milken would be in textbooks as a straightforward financial innovator. Then the same instrument was pointed at a different target. Here is the mechanism, and it follows directly from what came before. If a bond can raise $1 billion to build a telephone network, it can raise $1 billion to buy an existing company. The money does not know what it is for. The leveraged buyout works like this. You identify a company whose assets or cash flows are worth more than its share price suggests. You borrow the great majority of the purchase price. You buy the company. And then, this is the essential part. The debt you used to buy it is placed onto the company itself. The acquired business now services the loan that bought it. If it works, the returns to the small sliver of equity are extraordinary, because leverage multiplies gains. If it fails, the company carries a debt load it cannot support, and what follows is asset sales, job losses, or bankruptcy. Before high-yield bonds, the scale of such a deal was capped by how much a bank syndicate would lend. High-yield bonds removed the cap. Suddenly, a buyer with modest resources could assemble a bid for a company many times their size, because the money came from the public market rather than from a lending committee. Put some numbers on it, because the abstraction hides what is actually happening. Imagine a company with a share price valuing it at $1 billion. It is unexciting but solid. It generates $200 million a year in operating cash flow. It carries little debt, and its management has been running it comfortably for years. A buyer offers $1.3 billion, a premium the shareholders are delighted to accept. Of that, perhaps $150 million is the buyer's own equity. The remaining $1.15 billion is borrowed, much of it in high-yield bonds paying, say, 14%. The deal completes, and now the debt sits on the company. Interest alone runs to something like $160 million a year against operating cash flow of $200 million. Before this transaction, the company had comfortable cover and choices. Now it has $40 million of headroom and a schedule. Everything follows from that arithmetic. Marginal factories close, because the cash they consume is now needed for interest. Research budgets are cut, because research pays back over 10 years and the coupon is due in 6 months. Divisions are sold, because a division that fetches $300 million retires debt immediately. Headcount falls. But notice where the money came from. Some of it genuinely came from running the business better, because a management team with a debt schedule cannot afford the comfortable inefficiency it previously tolerated. That is the honest defense of the leveraged buyout, and it is not nothing. And some of it came from things that were not efficiencies at all. It came from wages that were not paid, plants that were not maintained, research that was not funded, and pension arrangements that were renegotiated. It also came from existing bondholders, whose safe bonds in an unlevered company became risky bonds in a heavily indebted one overnight, without their consent and without compensation. The two sources look identical on a spreadsheet. Both show up as improved returns to equity. Distinguishing them requires looking at the company 5 years later, which is precisely what nobody involved in the transaction was paid to do. The best documented case is the buyout of the Safeway supermarket chain in 1986. The deal was financially successful, and its defenders can point to real operational improvements. It also involved tens of thousands of employees losing jobs as stores and divisions were sold or closed, and a Wall Street Journal investigation into the human consequences won a Pulitzer Prize in 1990. Both of those statements are true simultaneously, and any account that gives you only one of them is selling something. That changed the balance of power in corporate America completely, and it did so almost overnight. For decades, the largest American corporations had been effectively immune to being bought. Their size was their protection. Nobody could raise enough to take them over. Their managements answered to boards frequently populated by friends, and to shareholders who had no practical means of forcing change. Now anybody with a credible plan and Drexel's phone number was a potential threat to any company in the country. The people who did this became known as corporate raiders, and their argument was that they were disciplining complacent managements who had grown fat on shareholders' money. Their critics argued they were asset strippers loading sound companies with debt to extract a fee. Both descriptions fit different deals, and the honest position is that the same mechanism produced both outcomes depending on who was using it and what they did afterwards. It is worth naming a few of them, because the abstraction of the raiders hides how different the outcomes were. T. Boone Pickens ran a modest oil company in Texas and made his name pursuing companies many times its size, most famously Gulf Oil. He did not win that one. What happened instead is instructive. Gulf, to escape him, sold itself to Chevron in what was then the largest merger in American history. Pickens and his investors made a very large profit without ever acquiring anything. He argued with some force that oil company executives were sitting on reserves worth more than their share prices and doing nothing about it, and that shareholders were entitled to that value. His critics noted that he was paid handsomely, whether or not any oil was ever produced. Carl Icahn is the case that cuts the other way, and it is the one worth knowing in detail. In 1985, he acquired TWA, at that point one of the great names in American aviation. The airline was taken private, and the debt from the acquisition was placed on it. To service that debt, assets were sold, including, in 1991, TWA's prized London routes, which went to American Airlines. Selling the most profitable routes to a competitor solves this year's interest payment and removes next year's earnings. TWA entered bankruptcy in 1992, again in 1995, and a third time in 2001, when what remained was bought by American. Icahn personally did well out of the arrangement. The airline did not survive. Those two cases bracket the argument. In one, the threat of a takeover forced a complacent board to surface value it had been ignoring, and shareholders benefited without the raider ever taking control. In the other, a functioning company was acquired, loaded with debt, stripped of its best assets to service that debt, and ultimately destroyed. The mechanism was identical in both. What differed was what the buyer did next, and nothing in the financing structure distinguished between them at the time the money was raised. A bond issue does not know whether the debt it creates will discipline a lazy management or dismember a sound company. It simply funds whoever is willing to pay the coupon. That is why the argument has never been settled. Defenders point at Gulf and at the genuine sloth of many American boardrooms in the 1970s, which was real. Critics point at TWA and at the towns that lost employers, which is also real. Both are describing the same decade accurately. They are simply looking at different deals. And then Drexel introduced a piece of paper that made the threat real before a single dollar had been raised. It was called a highly confident letter, and it was about a page long. In it, Drexel stated that it was highly confident it could raise the financing required for a proposed acquisition. It was not a guarantee. It committed no capital. It was, in legal terms, close to worthless. It was also devastating because everybody knew Drexel could do it. The letter converted Milken's placement network into a weapon that could be deployed instantly. A raider no longer needed committed financing to launch a bid. He needed a letter, and the target's board had to treat the bid as real. Think about what that does to a boardroom. A company receives an approach from a buyer with a fraction of its resources and cannot dismiss it because attached is a page from a Beverly Hills trading desk. The board must respond, defend, find another buyer, take on debt themselves to make the company unattractive, or accept. An enormous amount of the corporate restructuring of the 1980s traces back to that single page. And underpinning it was the network, which is where the story starts to darken. Drexel held an annual conference in Beverly Hills for high-yield issuers and investors. Officially, it was the High Yield Bond Conference. It became known as the Predator's Ball, and that name, the title of Connie Bruck's 1988 book, stuck because it captured something real. In one place, once a year, sat the people who issued this debt and the people who bought it, and the man who connected them. The concern about that arrangement is not complicated. When a market's buyers and sellers are substantially assembled by one intermediary, prices in it are not independent evidence of value. If the same network buys your bonds and you buy theirs, and the connector arranges both, then the market price is partly a fact about the network rather than about the companies. There is no need to allege conspiracy to see the problem. A closed circle can produce prices that look like a market and are not one, and everyone inside can be acting in good faith. By 1986, the high-yield market had grown from almost nothing to a couple of $100 billion. Drexel had risen from an also-ran to one of the most profitable firms on Wall Street, and Milken's operation generated a large share of it. The takeover wave was reaching companies once thought untouchable, culminating in a fight for RJR Nabisco that ran past $25 billion and became the defining deal of the era. That last deal deserves a moment because it is where the decade turns. RJR Nabisco was a tobacco and food conglomerate, Camel cigarettes and Oreo biscuits under one roof, and in 1988 its own chief executive proposed to take it private, buying it from its shareholders with borrowed money. What he had not anticipated was that announcing such a plan is an invitation. Once a company is formally in play, anyone may bid. What followed was a bidding contest conducted at a speed and scale nobody had seen, and it ended with the buyout firm KKR acquiring the company for roughly $25 billion, the largest takeover in history at that point, and a record that stood for years. Two details are worth carrying away. The first is that the winning bid was assembled in days rather than months, which was only possible because the high-yield market had been built to move that fast. The second is that Drexel was not the victor. Milken's firm participated on the losing side, and the deal was won by a rival with bank financing and its own access to the bond market. That second point is the one people miss. By 1988, the mechanism had escaped its inventor. Other banks had learned to underwrite this paper, other buyers had learned to hold it, and a takeover of unprecedented size could be financed without the Beverly Hills desk being decisive. The market Milken created had grown larger than the man at its center, which mattered enormously for what happened next, because a market that no longer depended on him could survive him, and the firm that did depend on him could not. At which point the government arrived. The unraveling did not begin with Milken. It began with Ivan Boesky, an arbitrageur who speculated on takeovers and who had been trading on information he was not entitled to have. In November 1986, Boesky settled with the Securities and Exchange Commission, paying $100 million and accepting a bar from the industry. What mattered more was the rest of the arrangement. He cooperated, and he had been permitted to sell holdings before the announcement, which itself caused outrage when it emerged. Boesky's cooperation pointed at Drexel and at Milken. The relationship at issue involved practices with a technical sound and serious legal consequences, arrangements in which one party held securities for another to disguise ownership, and accounts were settled through invoices for services that masked the true nature of the transactions. That is what the case was actually about. It is worth stating plainly because it differs from the popular memory, in which Milken is a straightforward insider trader. In 1988, prosecutors made clear they were prepared to charge Drexel itself under the Racketeer Influenced and Corrupt Organizations Act, RICO, a statute written for organized crime. The significance of RICO here is not the sentence. It is what an indictment did to a securities firm before any trial. RICO permitted the government to seek forfeiture of assets pre-trial. A financial institution depends entirely on counterparties being willing to face it. A firm whose assets might be frozen is a firm nobody will trade with. An indictment was therefore close to a death sentence, regardless of guilt. This is a genuine issue about prosecutorial power, and it should be acknowledged whatever you think of the defendants. Faced with a charge that could destroy the firm before a jury heard anything, Drexel did what any firm would. In December 1988, it agreed to plead guilty to 6 felonies and to pay $650 million, the largest securities penalty in history at that point. And it agreed to cooperate against Milken. He was indicted in March 1989 on a very large number of counts. In April 1990, he pleaded guilty to 6. And this is the part I most want to be precise about, because it is almost always reported wrongly. The 6 counts were securities and tax offenses arising from the Boesky relationship and related dealings, assisting in the filing of false documents, mail fraud, conspiracy, and helping to file a false tax return. Insider trading, the crime most people associate with him, was not among them. That is not a technicality, and it is not an exoneration. He admitted to serious federal felonies, and the conduct involved deceiving regulators and the market about who owned what. But it is materially different from the popular account, and the difference matters when we assess the sentence. In November 1990, Judge Kimba sentenced him to 10 years, far longer than most observers expected for the counts he had admitted, and widely read at the time as a sentence for a decade rather than for 6 offenses. He served about 22 months. The sentence was later reduced in recognition of his cooperation. In total, he paid roughly $600 million in fines and settlements, and he was barred from the securities industry for life. Drexel Burnham Lambert did not survive. Weakened by the fine, deprived of the operation that generated its profits, and shut out of funding markets, it filed for bankruptcy in February 1990. A firm that had been among the most profitable in America was gone within about 14 months of the plea. And the market he built, it fell hard, then it recovered, and it never went away. The high-yield market seized in 1989 and 1990. Defaults climbed as deals financed at the peak failed. Thrifts were forced by new legislation to dump their holdings into a market with no buyers, which drove prices down further. A story this channel has told in its own right, and the reason the 2 episodes are connected but not the same. The seizure is worth describing properly, because it shows how a market with one center actually fails. Through 1989, the deals had been getting more aggressive and the cushions thinner. In September, Campo Corporation, which had bought 2 large American department store groups with enormous quantities of borrowed money, ran short of cash. The news that a marquee high-yield borrower could not meet its obligations moved the whole market at once, because investors who had been treating these bonds as a category rather than as individual credits now re-rated the entire category, exactly as they had done in the opposite direction on the way up. In October, a proposed employee-led buyout of United Airlines collapsed when its banks would not provide the financing. The stock market fell sharply on the news in a single afternoon. The signal was unmistakable. The money that had made any deal possible was no longer automatically available. And then the buyers disappeared, which is the part that matters. For a decade, an investor wanting to sell high-yield bonds could call Milken's desk and get a price, because he knew who wanted them. With Drexel under indictment, that desk was no longer a reliable counterparty, and by 1990 it was gone entirely. The bonds still existed. The companies still paid their coupons. But the mechanism that turned a bond into cash on demand had been a network centered on one firm, and when the firm failed, the network did not transfer to anyone else. Legislation compounded it. New rules following the savings and loan crisis required thrifts to divest their high-yield holdings, forcing a large body of sellers into a market that had lost its principal buyer. That is a story this channel has told in its own right, and it is the point where these two episodes touch. But the S&L collapse had many causes of its own, and junk bonds were one line in a much longer bill. Prices fell far below anything defaults justified, which is the signature of a liquidity failure rather than a credit one. Investors who could hold through it did well. Investors who had to sell did not. Yet the instrument itself was sound, and the proof is that it is entirely normal today. The high-yield market is a permanent, enormous part of global corporate finance. Companies below investment grade routinely raise money in it. There are index funds for it. The idea that a company's credit rating determines the price of its debt, rather than its right to issue any at all, is now simply how finance works. That is the strangest part of the legacy. The mechanism was vindicated completely. It was the concentration around it that failed. But before scoring the man, there is a question about the founding insight that deserves a straight answer. Was Hickman actually right about the bonds Milken went on to create? This matters more than it might sound, because the two things are not the same. Hickman had measured fallen angels, bonds issued by established companies that were downgraded later. Milken's great innovation was original issue high yield, bonds sold as speculative from the first day to companies that had never been anything else. The evidence for the first was being used to justify the second, and that is a genuine logical gap. There are reasons to think the gap is real. A fallen angel is a company that was once good enough to earn an investment-grade rating and has stumbled. It has a history, established assets, and often a plausible route back. A company that was never investment-grade at all may be a fine business with a short record, or it may be a business that has never been able to demonstrate it can survive a downturn. Those are different populations, and Hickman had studied one of them. There is also a selection problem in the timing. Through most of the 1980s, the American economy grew and interest rates fell, which is close to ideal weather for a borrower carrying a large amount of debt. A strategy that performs well in those conditions has not yet been tested. It has merely not yet been tested. The market's real examination arrived in 1989 and 1990, and the results were considerably worse than the promotional material had implied. Academic work on this ran for years afterwards. Edward Altman, whose research on corporate default became the standard reference, found default rates on 1980s issuance that were substantially higher than the early sales pitch suggested. Particularly, once you measured defaults against the year, a bond was issued rather than against the size of a market that was growing rapidly, which flatters the numbers by comparing this year's defaults to a much larger denominator. The fairest summary is this: the core insight that a category rule was excluding an entire class of borrower and that the exclusion created a mispricing was correct, and it has been vindicated permanently by the market that exists today. The stronger claim that a diversified portfolio of newly issued speculative bonds was reliably a superior investment was oversold during the boom and did not survive the test of a recession, which is a fairly ordinary pattern in finance. A true observation gets turned into a marketing claim. The marketing claim outruns the evidence, and the correction falls on whoever bought last. So how should we actually score this? Start with what is genuinely to his credit. The insight was real, it was correct, and it had been available in a published study for 20 years while the whole of American finance ignored it. He democratized access to credit for companies that had been locked out by a rule that mistook a category for an analysis. Businesses exist because of it, in telecommunications, in cable, in cellular, that would otherwise have been strangled by their inability to borrow. Now the other side. The same instrument pointed at takeovers, imposed real costs on real people, and the arithmetic of a leveraged buyout is unsentimental. Debt service comes first, and it is paid from cash flow that would otherwise have gone to wages, investment, or slack. Some of those deals genuinely improved badly run companies. Others transferred value from employees and bondholders to a small group of buyers and their advisors, and left the business weaker. And there is the concentration. A market where one desk connects most of the issuers to most of the buyers is not the neutral price discovery that the case for high-yield debt depends on. The intellectual argument for these bonds was that the market had mispriced them. It is hard to sustain that argument when the market has become, in significant part, one man's phone list. Then the conduct which he admitted. Not the crime of the caricature, but real offenses involving deception about ownership and false filings, committed by someone who did not need to commit them, which is the detail I find hardest to explain. He was the most successful financier in America. The conduct he pleaded to concerned relatively marginal advantages. He was pardoned by the president in February 2020, 30 years after the plea. He had by then spent decades in medical philanthropy, following his own cancer diagnosis, and the institute bearing his name had become a fixture of economic conferences. Here is the thought I am left with, and it is not really about him. His insight was that a rule intended as a safeguard had become a barrier, that below investment grade had stopped meaning risky and started meaning forbidden, and that the gap between those two words was worth a fortune. He was right. He found that gap and he was paid enormously for it. But the reason the gap existed was that the rule was doing something useful for the institutions bound by it. Pension funds were restricted from speculative debt because pension funds hold other people's retirements. An accrued rule that a trustee cannot argue their way around has real value precisely because it is crude. Milken proved the rule was costing companies money. He did not prove it was costing them more than it saved. And when the barrier came down, what flowed through it was not only capital for entrepreneurs who could not otherwise borrow. It was also the ability to borrow against a company in order to buy it. Both of those came through the same opening. Nobody found a way to admit one and not the other, and nobody has since.